just to introduce the speakers today. Today's presenters are Stephanie Anderson, financial planner and wealth management manager extraordinaire, and myself, Greg Estes, director and chief investment officer. Between the two of us, we have together more than 6 decades of experience. And we are here to help you stay informed and empowered with valuable insights, we hope, into markets and into your own particular planning needs and how things might fit for you as you look at what you need and what makes sense for your plan. As I mentioned, this is an MBI webinar. MBI is a full-service wealth management firm. We take a holistic approach. We offer comprehensive financial planning and other services such as investment management and retirement planning. We try to make sense of a number of things for our clients so that they can achieve their goals and objectives. So just to give you an idea of what we're going to cover today, if you've been on these webinars before, much of it is a similar format. That is to say, we will look at the economy and the outlook there. We'll cover market fundamentals, in particular the equity markets, as well as the fixed income outlook. And then Stephanie will go through. It's called a financial planning guide. I believe it's a little more comprehensive than that, but the words here are just to, keep it brief, but it is just a really good way for you to start your year off right and make sure that you have your bases covered when it comes to financial planning. So like I said, if you've been on these webinars before, I like to start out with a little bit of humor. And one of the topics that doesn't seem to want to go away is inflation. And I'm sure the Fed would wish it would go away, but it keeps sticking around. And while it has come down, it hasn't quite gotten to the level that has given the market comfort that the Fed can enact the policy that it wants to, which is to cut rates. They've done it this year or in 2024, late in 2024. But given the fact that inflation remains somewhat buoyant, it's been problematic for them to move at the pace that they wish to do. But let's take a step back and look at how the economy itself is performing. So typically when GDP, gross domestic product, which is basically economic output for the US, the way that's measured, it's given to us quarterly. So as you can see, the chart on the left is showing you quarterly economic growth going back to 2021. So all of these purplish bars represent actual numbers reported. So the most recent number reported was for the third quarter of 2024 at a 2.8% growth rate. These gray bars represent what economists think is kind of a consensus for forecasts for economic growth going forward. So the next quarterly result will be for Q4, which ended at the end of 2024. And you can see these gray bars are really more between 1.5% to 2%. That's the expectation. And you can see that the most recent results reported, Q2 and Q3, were above that level. And I mention this because the chart on the right is giving you something of a look ahead at where that Q4 result might actually end up being. The Atlanta Fed produces its own estimate, which is updated frequently for what Q4 results will look like. That's called the GDP Now, and that is the green line. And what you can see is this blue range is the blue chip consensus. That is to say, what's the estimate for Q4 results? What is it going to look like? We'll get it at the end of this month. But what you can see is that this green estimation is running above that. And that's kind of a theme in economic results, is that they've been doing better than expected. And that's a positive for the U.S. economy. Another key part of the economy is the labor market. And how have, for example, payrolls, the chart on the left, and unemployment, the chart on the right, how do they look? So payrolls is basically the number of non-farm jobs created in the US. And what you can see is the most recent result was for December. We got that just within a couple of weeks previous to today. The results: 256,000 jobs created, well over 100,000. It was 100,000 more, well over expectations. So the expectations were for about 155,000 jobs created. So this number actually blew past expectations. What's interesting, I will note, is that the market actually responded somewhat sourly to that result. And you might be asking why. That sounds like good news. It is good news, but sometimes the market is thinking ahead or at a second level. And their thinking was, well, this means that the economy's doing better than expected and might be running hotter, which means that inflation might be more buoyant or stubborn than we thought, which means that the Federal Reserve may not be cutting rates as quickly as we want. So the net result is that a positive thing is perceived somewhat negatively in the market. And those, and I want to point this out because sometimes actual results and perceptions are a big deal for the stock market. Unemployment rate has actually come down. The latest unemployment result was down to 4.1%. So that's historically very low. One thing I want to note is in 2024, at about 2 webinars ago, so back in July, the unemployment rate started to creep up, still historically low, but it started to creep up. And that was causing the market to start to worry that unemployment was going up and maybe the economy was slowing down. But we can see that, the economy is still performing very well. And as a matter of fact, is performing generally better than expected. And to that notion of performing better than expected, I show you here the Citigroup Economic Surprise Index. So this is a neat index that kind of gives you an amalgamation of all of this economic data and basically is telling you what is the net result. Is it better or worse than the expectations of those results? So if the reading is above zero, that means there are more positive surprises. If the reading is below zero, more negative surprises. And what you can see as we went into the back half of 2024, the economic surprise index reading went very positive. So in other words, the economy was performing better, significantly better than expected. Well, what happens when you keep outperforming expectations? Eventually, those expectations start to move up. So you can see that the reading started to move back towards zero. But if you look very closely, the most recent history on this into 2025 is that once again, the economic data is outperforming expectations. So even with those higher expectations, the US economy is performing rather well at this point. I think the one fly in the ointment, if you will, as I alluded to at the beginning with that cartoon, is it has been inflation. So inflation has moderated. What you are seeing are two different measures of inflation in this chart. And I like to keep this chart updated so people can see what's going on. There are two measures, as I said. The red line is the Personal Consumption Expenditures Index, PCE. This is the Department of Commerce basically follows this index, creates this index, publishes this index. The yellow line is the more commonly known one. That's CPI, or Consumer Price Index, that the Department of Labor is responsible for publishing. These are both core measurements, which means we exclude food and energy from the basket to determine what price growth looks like on a year-over-year basis. So if you look at this chart at any one point in time, what it's telling you is how much prices have increased from the previous spot 12 months ago. So if you look at where we were in 2022, both of these measures were at decade highs, and they've since trailed off. Now, really quickly, the blue line is what the Fed funds rate has been. This is where the Federal Reserve controls that interest rate. So as inflation was very high, they moved very quickly to raise the Fed funds rate, raise interest rates to basically a 5.5% level. Since then, they've cut rates a few times in 2024, so that we are right now at 4.5% at currently. So they cut rates once by 0.5%, and then they did a couple of more rate cuts by 0.25% each to get us down 1% from that 5.5 level. I have here circled the very last readings of inflation. You can see that we've been moving sideways for the most part on inflation. It's this thing that won't quite get to where we hope it will get, which is 2%, which we've got highlighted in green. I do want to note, it's a little bit hard to see maybe, but the most recent CPI number, which just came out not too long ago, was actually a little bit lower than expected. So in this case, the market was received that news very favorably, and the market has been rallying kind of on that because, again, it's kind of a chain reaction or a domino effect. If inflation is indeed coming down towards 2%, then perhaps that means that the Fed can cut rates faster than expected. And if they can do that, that would be a positive for stocks. So that remains to be seen. That's one data point, but it is a positive data point and means that inflation might be moving again in the right direction. So I do want to talk about how the stock market has performed. Now, because we are having this webinar, and there have only been basically 3 weeks in the year. I want to give you a little bit more data than that. So this chart goes back to the beginning of 2024. So if you look at the far left, 1/1, that's January 1st of 2024. And what you're seeing at any given point in time is how, since that January 1st date, how that particular equity index is performing on a percentage basis. So the different equity indexes in this case, the Russell 1000 large cap index, the red is the Russell mid cap index, green is the Russell 2000 small cap index, and the purple is the all country world index ex-US. So everything outside the US in one index. And what you can see over time is, number one, in the summer months of 2024, there was quite a bit of volatility. You can see that throughout the entire period in time, large caps have been the leader. In some cases, this was due to the fact that, and there have been a kind of a few phases going on into 2024. And what I mean by that is, the first 6 months of 2024, the market was not very positive on the Fed and when they were going to cut interest rates. So the market was kind of gravitating towards large cap stocks. Once the market felt certain that rates would start to get cut, which they did in September, we started to see other areas of the market pick up and a little bit of a mini rotation going on from large caps to mid and small cap stocks and even international. But from there, as we went further into 2024, you can see, by the way, in November, this election, post-election rally, which did not include international stocks. But what you can see is this gap between large caps and mid and small caps started to widen out again when the market again grew less positive that the Federal Reserve would continue to cut interest rates as quickly as they had been in 2024. And at this point, we're left with a market that's once again started to show some signs of a bit of a rally. And a lot of that, like I said, had to do with the fact that the inflation number came out was better than expected. And maybe, just maybe, the Federal Reserve's approach will be to cut rates a little quicker. Again, it's very early days to be thinking about that. And there's a bit of the market has kind of two minds as far as how aggressive the Federal Reserve will be when it comes to cutting interest rates. What I want you to take away from this is that if the Federal Reserve is cutting interest rates, that's generally considered positive for stocks because lower rates means lower borrowing costs, higher valuations on businesses. So generally, that's why the market makes a big deal about what the Fed is going to do as far as rate cuts. I decided to throw in something that's a little bit different than what we would normally look at. This is the bull to bear ratio. Now, this is somewhat of a technical indicator, and what that means is that it tends to be a little bit more short term. It's not a long term view, but the reason I'm bringing it up, and by the way, we have two charts. They're measuring the same thing, but they come from two different sources: Investors Intelligent and Intelligence, and the bottom chart is AAII. What they're doing is surveying people. Are you bullish? Do you think the market's going up? Or are you bearish? Do you think the market's going down? And each has kind of a long-term historical average of the number of bull investors to bear investors. And that's measured by the dashed red line. So the reason this can kind of be a big deal is when there are a lot of bulls out there. That sounds like a good thing. Oh, everyone's very bullish. That's good. But it's actually somewhat of a contrarian indicator because if everyone is bullish, all it takes is a little bit of negative news or even news that is not exceeding expectations for the market to pull back. So what you can see in both of these measures is that bull to bear ratio started to come up at the end of 2024 and was getting a little too optimistic. And what we can see in recent history is that there's been a bit of a correction there where that bull to bear ratio has started to come back down. That's actually positive because what that means is we don't necessarily need fantastic news for the market to go up. And in addition to the notion of people's own perceptions about the market and what it's going to do, is the fundamental data out there, which is how are corporate earnings doing? And if corporate earnings are growing, that's generally good for stocks. So what we're looking at in this chart is quarterly earnings growth going back to Q1 2022. And what you can see is that earnings have been growing since the midpoint of 2023. This is very positive for stocks. If businesses are growing their earnings, then that should imply that the value of those businesses is growing. And if the value of the business is growing because its earnings are getting bigger, then generally speaking, that offers support for stock prices. So what you can see, Q4 2024 hasn't fully been reported. The expectations look pretty good for fourth quarter earnings. And as a matter of fact, they just started in the last week with some of the banks, and they've been very positive. JP Morgan, Goldman Sachs had really fantastic numbers. That doesn't necessarily mean that everything's going to do well, but generally the direction seems to be that earnings are going to continue to grow. Again, that's a very important point to make. Fundamentals matter in the market and they offer support for stock prices. Okay, so changing gears. So we talked a bit about the Fed funds rate and what expectations are for the Fed funds rate. So I mentioned, as we looked at where inflation had been, the Fed had raised the Fed funds rate. And by the way, if you don't know what the Fed funds rate is, it's basically the rate that the Fed sets that banks can charge each other for overnight interest on borrowing between each other, between banks. So that was at 5.5% until the Fed started cutting rates back in September. It's now at roughly 4.5%. So these probabilities are measuring is the probability of Fed funds rate being a certain level in the December 2025 meeting. So by the end of the year, where will the Fed funds rate be? And what you can see is the market generally isn't expecting a lot of rate cuts in 2025 at this point. Most of the probability is on this 375 to 400. In other words, basically 2 rate cuts for 2025, another 30% probability on just 1 rate cut. So the bulk of the market isn't thinking that there will be a lot of rate cuts. Now, what that means is if inflation does indeed start to show signs of coming down, that will be positive because the market's already expecting very little activity from the Fed as far as rate cuts going into 2025. If inflation remains stubborn, um, depending on if it doesn't go up but just continues to move sideways, that's kind of already implied in stock prices at this point. So it remains to be seen. We still, data continues to come out, but the expectations right now are not for a lot of rate cuts in 2025. Um, just real quick, mentioning some other issues. The yield curve, this is looking at interest rates from, very short-term maturities at 3 months all the way out to 30 years. And what you can see is, this chart's maybe a couple weeks old, but, it says a month ago, it's about 6 weeks ago, that yield curve was essentially a cup where long-term rates were about the same as very short-term rates. That's changed quite a bit. And this has to do with the fact that the market, especially the bond market, has come to grips with the fact that they don't believe the Fed is going to cut rates a lot. So they've moved those longer term rates up. Sometimes that's called a bear steepener. It is somewhat bearish because with higher rates and long-term rates, that's generally not a positive for stocks. We've gotten past the point where those long-term rates have been moving up. They've actually been coming down a little bit in recent history. But suffice to say, with higher longer-term rates, that can lead to more volatility in equity markets. The chart on the right is looking at something a little bit different, and this is taking a longer-term view. Typically, we don't think of, when we look at stocks, we don't think of earnings yield, but you can think of, rather than just the dividends that stocks pay out, and we talk a lot about price to earnings, what about if we flip that earnings to price? In other words, stocks generate a certain level of earnings. If we think of that like a yield, even though we don't get paid all of that money into our hand, if we think of it as a yield and we compare that with the 5-year Treasury yield, what you can see is that for a very long period of time, this blue line, the 5-year Treasury yield, was very, very low. Interest rates were extremely low, and earnings yield in the stock market was much higher. So there was a preference for people, even people that needed fixed income, to gravitate towards equities. But what we can see in more recent history is that we're getting to a level of parity between the 5-year Treasury yield and the 1-year forward earnings yield in the S&P 500. So what does that mean? What is the takeaway for you? Well, every individual has their own sort of inherent target asset allocation. How much equity should you have versus fixed income? That's something that at MBI that we help our clients figure out and work towards investing them at a certain target asset allocation. So maybe yours is 60% equity, 40% fixed income, or 70% equity, 30% fixed income. Well, back in the early 2010 through 2015, the earnings yield was so much higher in stocks than in fixed income. You might, even though you had, say, a 60-40 split in your long-term target asset allocation, you may have been biased towards having a bit more equity in your portfolio because of this disparity between the earnings yield and the Treasury yield. So in other words, maybe instead of 60-40, you might have been 65-35 or even 70-30. You would have been biased towards equities. Well, if we're at parity now, what this is telling us is that you really should think about being more in tune with what your target asset allocation is. Don't get out over your skis too heavily into equities. If you have a 60-40 equity to fixed income allocation, you probably want to keep it that way because, simply put, the yield on fixed income is to the point now where it makes sense to have that fixed income filled in your target asset allocation. Just real quick, the return on treasuries, 10-year treasuries over 2024. The reason we pay attention to even on the equity side, the 10-year treasury is because it's very important for kind of how we understand discounting of equities and the directionality of maybe the stock market. And what you can see is as the early part of 2024, 10-year treasuries were actually having a negative return. And this is due to the fact that rates weren't coming down like expected. There's an inverse relationship. When rates are coming down, bond prices are going up, and that's good for 10-year treasury. But as the Fed funds started to cut interest rates, the 10-year treasury started to perform very well. Now, a lot of that's kind of faded. As I showed you before, the yield on longer term rates has actually moved up. So some of that 10-year treasury return has faded a bit. But it is something that we keep an eye on so we can understand kind of directionality in equity markets as well as fixed income markets. I have a couple of charts left. That is, we want to look at where growth is relative to value. And what I mean by that is this is a forward price to earnings ratio. So how many dollars are you willing to pay for a dollar of next year's earnings? Okay, so we've got stocks separated into two categories. The blue is growth stocks, those that may have low earnings today, but are expected to have a high earnings growth rate in the future. And value stocks, which are more stable, more dividend producing, but aren't growing as fast. Their earnings aren't growing as fast. So how expensive are these two different categories relative to each other? And what you can see is that growth stocks, again, towards the end of 2024, started to get very expensive relative to value stocks. So that means that they've done well, but what it also means is that they've gotten significantly more expensive. They tend to be more expensive historically than value stocks. That's natural, but how much more expensive they are, it changes over time. So if this gap between growth stocks and value stocks closes, it's most likely because growth stocks start to sell off or the market starts to rotate towards value stocks. So just you should be aware of this in your own portfolios. How exposed are you to growth? Are you heavily overweighted in growth stocks? It's probably worked for you. You might want to consider trimming some of that exposure back. And another way of looking at this, instead of looking at growth versus value, is how exposed are you in large cap stocks versus mid cap and small cap stocks. Now, what we've seen is there's been this kind of big gap between large cap and mid caps and small caps. Typically, and we started to see this in 2024, and then it kind of faded. If rates do start to move back down again, it's generally going to be, it's positive for all stocks, but small and mid cap stocks might benefit from that a bit more. Again, just to be in tune with your own portfolio and make sure that you have some level of balance in your portfolio. That doesn't mean equally weight your mid small caps with your large caps, but it does mean that you do want to pay attention to having diversification across these different classes of stocks and make sure that you have some exposure to mid and small cap stocks, which are clearly cheaper than large cap stocks. With that, I am going to turn it over to Stephanie to give you her thoughts on 2025 and financial planning.
Great. Thank you, Greg. And thank you to all who've taken time out of your busy schedules to join us today to talk about this important topic. If we move to the next slide, we know this, we all know this. January is a time to turn the page, to start fresh, and to come up with some resolutions for the year. Most of these resolutions are pertaining to health or exercise or diet or fitness of some sort. But as you can see on this chart, based on a survey done by Pew Research Center, coming in at second was money and finances. So for those people who made at least one New Year's resolution in the year, and this survey was conducted last year, most people had resolutions regarding exercise or health and diet. But the second most popular resolution was regarding money and finances. We all know what happens. We start off really strong, and then maybe by February or March, these resolutions have petered out. As we see on the next slide, unfortunately, this is what's happening in reality with regard to finances. In a survey that was done by Schwab last year, only about a third of Americans had documented a financial plan, had determined what their goals were, and had actually written those goals down in a formal plan. Interestingly, of the people who had gone through that planning process, more than 90% of them reported that it made them feel very confident that they would reach their goals. They felt more in control of their finances. So the focus then is on what's happening that's causing nearly 2/3 of people not to have a formal financial plan in place. And the focus today is to go through kind of a guide or a framework for having these conversations with yourself. And then this will sort of tee you up or set you up to have a really productive conversation with an advisor. As we see on the next slide, the process is pretty straightforward, right? We're at the beginning of the year. We want to first, as I mentioned, revisit or establish goals. What's really important to me? What are my interests? What are my values? And how can I identify these things and then clarify them and then articulate them and put them in writing? That's the first step in the review process. The second step, which you can start right now and you can continue throughout the year, is to assess what your current situation is. And particularly because we're in January, you want to look at things relative to what was going on last year in 2024. The third step in the process is to identify areas that need attention. Sometimes it's just, this needs attention soon. There are, in some cases, and we'll touch on this a little bit later, there are items that really need immediate, urgent attention. The fourth step in the process is to identify the route or the path that you're going to take to achieve your goals. You might liken this to when you plug in an address in Waze or Google Maps or whatever your GPS system of choice is, and it will give you alternate routes to get to any particular destination. That's a similar situation in financial planning. Very rarely is there only one right answer or one path that you can take to achieve your goals. But it's very important to start with that first step and figure out what's important to you, because you could have the most, thoughtful, well-executed plan, but if it doesn't really link tightly with what's important to you, what your goals and values and objectives are, then it's really a waste of paper and ultimately a waste of time. As we can see on the next slide, there are a couple of ways that you can begin to uncover or tease out what's really important. And if you haven't read any of the works of George Kinder, I would urge you to take a minute and do so. But in the interim, we're going to focus on these really three important questions. George Kinder is sort of the father of modern life planning, which is really linking what's important in your life to the underlying financial planning process. These are three questions that he asks people to help you uncover what's important. I won't read everything here on the slide, but I'll highlight for you sort of the essence of each of these three questions. And you could also call them scenarios, right? Because if we were doing some modeling, we could model out what these different scenarios might look like. So in question one or scenario one, you're sort of designing your life, at a broad 30,000-foot level. It's assuming that you have enough financial resources to take care of yourself now and into the future. So money is not a concern. In that case, what would you do with your life? How would you allocate your money? Once you envision that scenario, how is that different from what you're doing right now, from how you're living your life right now? Jot those thoughts down when you have a moment to go through these questions offline, and then stick a pin in that. Question two or scenario two, you have less time. You go to the doctor and the doctor tells you that you have 5 to 10 years left to live. The good part is you're not going to be sick. You're just going to, boom, go without a moment's notice. So the thinking there is, What would you do with the time that you have left? What changes would you make, and how is that different from what's going on in your life today? And then scenario 3 is you get really bad news. You have 1 day left. Obviously, not a lot of time to be doing a lot of things. So the question is to kind of sit with, to uncover what dreams were left unfilled. What do you wish that you had done? What kind of a person do you wish you had been? What did you miss? Is really the thought there. These are 3 questions. You can't go through them quickly. I would urge you to get whatever your beverage of choice is and spend a little quiet time pondering these questions and jotting your thoughts down on a blank sheet of paper. Your spouse, your partner can also do this. Your children, anyone in your circle. These are questions that are worthwhile to ponder. Once you've done that, then as we can see on the next slide, you want to start to link these overarching goals and objectives, values, things that are important to you, to what I call the load-bearing pillars of your financial blueprint, right? And that's in essence what we're doing when we're putting together a financial plan. You have a sort of a lifestyle or a life structure, if you will, that you're trying to build. And these are the load-bearing pillars that will support that life structure or that lifestyle. Those who've joined this webinar before have seen a variation of this chart, but I'll just highlight from left to right the key important pillars. The first is cash flow. This is kind of a broad category that encompasses your income, your expenses, your net worth, and for those who are on the runway toward retirement, that there's also a lot of discussion there that cash flow is particularly important in that particular chapter of life. The next pillar is taxes. We all recognize that we have to pay taxes, but no one wants to pay more than his or her fair share of taxes. So here we're looking at kind of marginal tax bracket management, considering the timing of income recognition, looking at whether or not you're optimizing all of your pre-tax deductions, whether that's retirement contributions, HSA contributions, etc. And then being really strategic about whether or not you should take a standard deduction or whether you should itemize and the timing of that choice. The third pillar is investments. This is obviously an important area because this is the funding source for your life in retirement in particular, but this is the nest egg that you're building so that you have flexibility and freedom in terms of your life choices. Here again, consistent with our theme of getting things in writing, is to have a written investment policy, to be clear about what your ability to stomach risk is, what your risk tolerance is, to have something clarified with regard to rebalancing, and then a drawdown strategy is going to be critically important in retirement, but it's important in any stage of life. And then finally, thinking about asset allocation, as Greg was talking about, stocks versus bonds versus cash, and the location of assets, right? Should it be in my taxable brokerage account, or should these assets be put in a retirement account, a pre-tax retirement account, or a tax-free Roth account? Or do I need to have more cash? So thinking through that whole process. The fourth pillar is estate planning. Here is what you would expect: wills, trusts, POAs for finance and healthcare, all your medical directives, beneficiary designations, thinking about charitable giving, and legacy planning. And the fifth and final pillar is really things that concern insurable risk. This category constitutes things that could really derail your financial plan if you haven't taken steps to minimize or neutralize the potential downside from these kinds of occurrences. That's premature death, disability, long-term care expenses, some unexpected illness, a damage to a property, or a legal judgment. That is the sort of framework for putting together your plan. As you take a look at this, I would urge you to evaluate, are any of these categories needing urgent attention? Or have you been focusing pretty diligently on all of them? Or Also, are there some areas that are not even on your radar screen? Very important to give consideration to that, because that'll help you to prioritize where you might focus your attentions. As we move to the next slide, and the following slides here, this is a little bit different. You're going to receive a copy of the slides after the presentation. I would urge you to print the slides off and use these templates to begin to clarify what your approach is for these various load-bearing pillars. Oops, can we go back
Yep.
one slide? Sure. To clarify what your approach is to these various load-bearing pillars that we saw on the prior slide, and if you are planning to make changes in your approach, there's space to note that. And then also to consistent with sort of the SMART goals, the T being time bound, you want to set some sort of a target completion date for getting these various items completed, to the extent that you have action items needing attention. I won't read these verbatim, but I'll just highlight a couple of things. In terms of cash flow, this is essentially what's coming in and what's going out. And how do I manage that? How can I enhance my income? How can I manage or reduce my expenses? What's going on with my net worth? Am I tracking it over time? A category that I will highlight that's here toward the bottom is retirement planning. We have a whole additional series of questions that we go through for people who are planning or on the, as I say, the runway toward retirement. Please reach out to us if you'd like to have additional conversations about that. But cash flow in retirement is especially important because the spigot of your salary has been turned off. So you really have to be clear about what your sources of income are, what your expenses are in the various phases of retirement, right? Go, slow go, and no go, I believe people affectionately refer to as the phases of retirement. So think about that. And then also to think, are there any age milestones that are coming up, or life milestones, whether that's a wedding or a birth of a child, or retirement, as we were just touching on. Anything significant with age, right? Have you reached age 59 and a half? There are some important milestones there in terms of not having penalties if you need to take some early withdrawals. Are you full retirement age, or are you 70, which is the last time when you need to start drawing Social Security? So these are important questions to think through to make sure that you have all of your bases covered here. I also would add on the next slide a sort of a summary. If you think back to those three important questions that we saw a moment ago, they would result potentially in very different life scenarios. Each of those life scenarios has different costs associated with it, right? There are different costs, there are different pluses and minuses associated with any different scenario that you come up with. This is an interesting exercise, I think, to go through, because it really helps you to be clear on the impact of different choices on your expenses in particular, fixed versus variable. It also helps you to clarify wants versus needs. And if you were to, I've done this exercise with clients before where we stand at a whiteboard and we have Post-it notes highlighting the big categories of expenses, and we move them around into these four different quadrants until people are kind of satisfied with what they have arrived at. This is an interesting exercise to go through, because particularly if you have different scenarios in mind, and I'll just as an example, living in a tiny house at the beach is going to result in a different array of Post-its in the quadrant versus living in, a large single family house in McLean or Great Falls versus living in a condo in downtown DC or in the West End in DC. So thinking through the implications for your finances of different scenarios or lifestyle choices that you might make is very, very important. This is going to be used to put together a spending plan. And again, we're trying to link this back to your overarching goals and values, as we've discussed. Taking a look then at the next slide, we move on to tax questions. here, again, I won't read these to you verbatim. The focus here is to figure out how you can legally or legitimately minimize your lifetime tax payments, right? So some of this is bracket management, as we touched on a moment ago, thinking about being very strategic about timing, the recognition of income. Do Roth conversions make sense for you, meaning to pay the tax now with the anticipation that taxes will increase in the future? Being very strategic about thinking through these different decisions or levers that you can manipulate from a tax perspective. Of course, we have a whole team of tax experts that are standing ready and available to help you should you need assistance with detailed assistance with the preparation and filing of taxes. We do cover these high-level strategic questions as part of the financial planning process. The next area that we cover on the next slide is investment questions. Here, again, is the theme that you'll notice is to get these thoughts out of our heads and onto paper. The important thing here is, am I clear on what my investment goals are? Because all of us have different pots of money. We have taxable money, we have retirement money, we have tax-free money, and we have cash. Each of those pots of money has a different goal or an objective. It has a different drawdown or needs for spending from that particular portfolio. All of these factors have an impact on how you will invest or allocate those various pools. So it's really important to be clear on that. And then when you roll all of the objectives for all of the different pots together, of course, you have an overarching investment policy statement that will govern how your funds are managed. Here again, we want to try to be efficient. We want to have an all-weather strategy that we can live with through a variety of market circumstances and conditions. We certainly don't want to be whipsawed by changing strategy based on emotion or whim. We want to have some protocols in place for decision making. Moving then to the next topic is estate planning. This is not a cheerful topic, but it's critically important, right? We can exit in a chaotic fashion or we can exit in an orderly fashion. I prefer to exit in an orderly fashion because unfortunately none of us is getting out of here alive. So here, the question is to start at the really foundational level. Do you have basic will or trust documents that are in place and executed? Are they current, meaning done within the last 1 to 3 years? Do you have your POA for finance and for healthcare? And your medical directives, have they been completed? And again, are they executed and current? And this is an area where sometimes people have the documents, but they forget to notify the people who've been tapped to make decisions for them, either in the case of incapacity or upon death. Have you actually notified the people that you've tapped? And do those people know where to find those documents in the event of an emergency? We'll continue on the next slide with, some other things that need to be focused on. This next point at the very top of the slide, I think I would put an asterisk or circle it. This is really important in light of the wildfires in California and the flooding that we've seen in the Southeast. In the event that your house, your safe, your office, wherever you keep your important documents, were no longer there, do you have a readily accessible electronic copy of all of these important documents? That's going to be particularly important. I'll just highlight a couple of other things. Have you done a summary list of beneficiaries? And are the people on that list, are they still, well and alive and able to receive whatever you have tapped for them? Important to do that. Remember that the beneficiary designations for your retirement accounts and your other various accounts trump what language is in your will. So you want to make sure there are no inconsistencies there. You also want to draw up a flow chart or have your advisor work with you to draw up a flow chart so that you have a clear understanding of how assets are going to be distributed. This is important so that you make sure there are no inconsistencies or unintended consequences based on whatever strategy you have put in place for distributing funds upon your passing. Let's see, anything else here worthy to highlight? The last thing is how you will handle gifting and charitable giving. This sort of ties back to the investments and rebalancing, right? Particularly if we think about the appreciation in the markets, large cap stocks were up 25% last year and a little over 26% in the year before that, some nice appreciation and potentially unrealized gains in portfolios. This is an opportunity to do some charitable giving. Instead of in cash, you could give appreciated securities, and then you also could consider some QCDs, right? If you don't need the RMDs and you maybe are not itemizing, that's a nice way to manage your taxable income. Just a few thoughts there. That's a long list of questions. Obviously, we could spend a whole seminar on estate planning questions. We'll finish up on the next slide with insurance and risk management questions. Here, again, in light of sort of these extreme weather events that we've been having, I think it's really important for everyone to do an insurance audit, to take a look at all of the different types of coverage and make sure that what you have in place is appropriate, and to ask, are there any gaps in my coverage that could come back to bite me, right? Most people have life and health and disability through work. Long-term care is a topic that reasonable people can disagree about. The focus here is just to have a long-term care funding plan. You can decide to self-fund, meaning you set aside a pot of money that will be conservatively invested and available for you to use in the event that you need it. Or you could offload the risk to an insurance company with either a pure long-term care policy, although those are increasingly difficult to get your hands on, or you have some sort of a hybrid life and long-term care policy. The highlight here is just to have a plan, and to have your policies in place. The one thing here, again, Greg touched on inflation earlier. You want to take a look as you're going through your policy documents on your own or with an insurance broker, is to make sure that the coverage levels that you've specified for replacement value, etc., are actually appropriate, right? Inflation may have impacted the amount of coverage that you would need. So that sort of takes us through the big pillars of your financial plan. If we take a look on the next slide, we just wrap up with a couple of things to keep in mind. I would really, again, urge you to think through the answers to those three key planning questions that we started out with, to take some pieces of paper and to take some time to really think through this exercise, and to do it with other members of your family. The next thing to keep in mind is we all have heard about SMART goals, right? Specific, measurable, achievable, relevant, and time-bound. As you're setting goals for yourself, try to be specific, right? And set those goals in this sort of framework, so that when you check back in mid-year and then at the end of 2025, you are actually pleased to see some nice movement and progress on these various topics. We've touched on this throughout, on this sort of multi-scenario approach to planning, right? There are different ways that each one of us could live our lives, right? While you're working, you could decide to live in the city versus, moving to another area. When you're in retirement, of course, the degrees of freedom open up considerably. So think through the impact in terms of your expenses and the income needed from this multi-scenario approach. We touched on the various pillars. Think through the impact on your finances of different life choices that you would make. We also touched on, in the insurance and risk management, what are the factors that could derail your plan, whether it's, again, premature death, disability, a long-term care event. Think through those to make sure that you understand them, and then work with your advisor and an insurance broker, most likely, to minimize or to neutralize, ideally, those kind of potential downside occurrences. And then the last thing, once you've done all of this thinking, I think you need to just put the paper away and get out there and live your best life. I was looking on the back of the Green Mountain coffee box this morning, and it said, "Be bold, be alive, grab a cup and get out there." I think that's a useful way to live one's life. With that, I think we'll take any questions that are still outstanding. Let's see. I think there was a question about how can credit come into play for financial planning for people looking to build credit towards toward big purchases? Here, if you're thinking about sort of bolstering your credit score, you really do want to be keenly aware of your expenses, your income, your debt to income ratio, because your lender's going to be looking at that, your payment history and the timeliness of the payment history, and also your usage of credit is going to be important, particularly if you're planning for a large purchase. It will be important to run some scenarios or do some modeling to make sure that those various metrics that the lenders would be looking at will still be in acceptable ranges with the addition, of a large purchase like a mortgage or, an expensive item such as a car. Let's see, is there anything else here? Um, Greg, I think there was a comment or a question about tariffs, potential market decline from tariffs being put in place.
So, good question. It's been on top of mind for a lot of people. Um, so, I think the thing that tariffs do is they theoretically create a one-time boost to inflation if enacted. But beyond that, they can create more volatility in the market, primarily because no one's sure what exactly the tariff policy is specifically. So, uh, in recent history, in recent days, the market's actually been trading up because they think, well, it sounds like the tariff is, for example, on China is going to be 10%, not 60%. Or if it materializes that the tariff is more talk and less implementation, then that would be good for markets. But it's like I said, it's adding more volatility to markets, and it could theoretically continue to keep inflation a little bit elevated, because tariffs are somewhat inflationary. So we have to stay on top of it and stay tuned to what might happen.
Okay. And I think a last question is, with unemployment rates remaining low, how might potential labor shortages affect growth and wage inflation?
Well, that's been kind of the big issue is the labor market's been strong, so these all these issues tie together. So getting inflation to come down is very challenging when you have a labor market that's strong. Now add on to that if for multiple reasons, such as like if you're deporting part of your labor force, um, you're shrinking the labor force. You can do one of two things. You can push more of the production to a smaller group of people, which is theoretically possible because productivity levels have actually been increasing. But generally speaking, that does help to keep inflation persistent with a labor market kind of going into somewhat of a shortage mode.
Okay. And I think that with that, we are at time. Thank you all again for joining us today. We hope that you have found this session to be useful and insightful and valuable. We will be sending out copies of the slides after the presentation, so please keep a lookout for that. And again, I would urge you to print those slides off and spend a little bit of time during the remaining days of the month of January and going into February to commit to writing your goals and objectives. Let's see. We will be sending out information shortly about our Q2 webinar, so please keep a lookout for that. And again, thank you so much for taking time out of your busy schedules to join us. We would love to chat further with you. If you have any questions, you have our contact details here on the slide. Please feel free to reach out for an introductory conversation. And with that, I bid you a wonderful rest of the day.